There continues to be interest in the 831B election as it relates to captive insurance companies. The 831B election is an IRS election for small insurance companies. At present, the IRS considers a small insurance company one that writes $1.2 million in annual premium. There's movement afoot within Congress to have this threshold raised to $2 million in premium. What this election allows a small insurance company to do is to pay federal income tax on its net investment income only, which in effect allows the underwriting profit to be tax exempt. Obviously, you want to make this election if you have predictable low losses, because if you do have an underwriting loss which creates a net loss, you still have to pay federal income taxes on your net investment income. Due to the low premium volume that this election allows, we see this election more in the captive industry. If Congress is successful in raising this limit to $2 million in premium, we feel that we'll see a lot more 831Bs formed with existing captives that are already around. But we must caution you that you need to qualify as a small insurance company to make this election. And to qualify as an insurance company, you need risk shifting and risk distribution. Under the safe harbor rules, if you're a single parent captive, you need at least 12 entities to qualify as an insurance company. With a group captive, you need at least 7. And the spread of risk needs to be somewhat relatively equal over all entities. Or you can write 30% of third-party business in the captive, which would also qualify you as an insurance company. However, you do need tax advice when making these decisions. The premiums in an 831B must be real. It must be coverage that you could get on the open market and at a cost that is conducive with traditional insurance carriers. USA Risk Group has been very successful in forming 831Bs over time, and most of ours have taken the 953D election in offshore domiciles. With 831B, as we know, the premiums are much lower, so there's a premium put on capital infusion and expenses that are paid by the captive. Offshore domiciles typically have a lower capital requirement, and their expenses are somewhat lower as well. For our captives, Barbados and the British Virgin Islands have been very attractive domiciles for us, and we've had quite a bit of success there. Again, you need to take the 953D election, which is an IRS election, which qualifies you to, even though you're offshore, you pay taxes as a U.S. taxpayer. We do have one very successful 831B that's domiciled in the British Virgin Islands, which writes $1.2 million a year. Its historic loss ratio is 17% over the last 20 years. With that kind of loss ratio and keeping an eye on expenses, the owners of this captive have been able to net over $900,000 in profits annually.